While the current challenging market environment may slow down development towards EVs, there will likely be more demand for these cars, and Tesla currently controls about 70% of the electric car market. Analysts predict that the EV market will grow at a compound annual growth rate of up to 20% through 2030. Other major automakers are attempting to catch up to Tesla at the same time. Hi everyone, happy to be back on everything. Tesla just released its third quarter delivery report for the year. In comparison to earlier this year, when a closure at its China facility and difficulties opening factories in Berlin and Austin limited how many vehicles it was able to get into customers' driveways. Tesla claims to have delivered 343,830 vehicles this quarter, setting a new record. Even though the automaker delivered more cars in the third quarter than it did in the previous year, the number of cars delivered fell short of Wall Street's expectations, which ranged from 358,000 to 371,000. Additionally, there was a wider than typical discrepancy between Tesla's delivery and production figures, leading some investors to surmise that the company might possibly be experiencing problems with demand. For the same period, Tesla's earnings fell short of Wall Street expectations. Tesla reported revenues of $21.5 billion, which came out to be about $500 million less than what Wall Street had expected, and earnings per share of 1.5 cents despite the decline in deliveries. The Wall Street consensus for the third quarter was $22 billion in revenue and $1 in earnings per share. Due to the increase in cars in transit at the end of the year, Tesla CFO Zachary Kirkland stated that the company anticipates delivery growth rates to be slightly less than 50%. Investors should anticipate a lag between production and deliveries in Q4, and that cars in transit will be delivered to customers upon arrival at their destination in Q1. But despite this disclosure, the CFO of Tesla Wall Street continues to maintain his 429,000 delivery projections for Tesla's Q4 cars that suggest a 43-year growth rate year over year are probably going to do better for Tesla than this, and strong deliveries will raise the price of the company's stock. Watch to find out. But before we dive right in, remember to like, subscribe, and enable notifications so you can stay informed about what Tesla is up to. These reduced earnings and delivery numbers, along with a number of other issues, had driven down the price of Tesla's shares as many investors were concerned about a potential crash in demand for the company. Let's say that Tesla surpasses Wall Street's projections for future deliveries by around 40,000 units. Could Tesla reach a 10% increase in a single day? Someone else sees early warning signs for the automaker, such as its increasingly premium pricing, at a time when the global economy is slowing down and expectations for global auto sales are being lowered. Meanwhile, Tesla's growth story is back, and the demand issue appears to be gradually fading. It appears like Tesla is still operating efficiently in terms of both production and delivery. Compared to many of its competitors, the automaker has handled supply chain difficulties better. An analysis that is still anticipated to show robust growth all year long as it increases output, per the Morgan Stanley research. Adam Hughes, although there is a need for prudence on pricing and Tesla's ability to handle the economic cycle, the company did not face an immediate demand difficulty. He claimed that it would be irrational to believe that Tesla could raise prices indefinitely without causing misery to people, and that the business was not vulnerable to slower macroeconomic development. Indeed, there are a number of although Tesla recently missed Wall Street's expectations, the automaker has previously beaten these expectations. Market take-ups steadily way down on Tesla's deliveries, but the automaker has actually shown signs of better delivery figures in the future, and if these numbers go up, Tesla's stock price may rise significantly in no time. By a wide margin, expectations for 2021, despite production issues brought on by the microchip shortage, Tesla reported its most profitable quarter, exceeding Wall Street's expectations. The automaker reported total revenue of $11.958 billion in the second quarter of the year, up 98% year over year, and surpassing the expected $11.36 billion in income additionally. The company's operating income increased to $1.3 billion with an 11% operating margin, and its gross profit increased by 128 to $2.884 billion. However, Tesla claims that the significant increase in revenues was caused by a significant increase in vehicle deliveries, with automotive revenues rising by 97 to $10.206 billion in 2020. Chinese production as a fraction of the whole mix helped increase profit margins as Tesla topped second quarter earnings projections and turned a profit. In response, Adam Jonas lauded the quarter's profit margins, which he said were very challenging for the industry as a whole. Tesla has demonstrated over the years that it is still committed to producing and delivering cars, even though current delivery statistics appear to be below expectations. These resulted from circumstances beyond the carmaker's control. According to Tesla, its manufacturing levels are still rising. Securing vehicle transport capacity during peak logistics weeks at a fair cost is getting more and more difficult. The manufacturer added that there were more automobiles in transit at the conclusion of the quarter as a result of its weekly shift to an even more regional mix of vehicle manufacturing. These problems are thought to be small setbacks for the automaker, which will quickly have to catch up. It's also anticipated that demand for Tesla EVs will increase, particularly given the burgeoning EV sector. In the United States, the average cost of an electric vehicle is approximately $67,000, which is 20 grand less than the average price of a record-breaking ICE car. But this is probably going to change as manufacturers of EV develop more affordable electric cars. In the future, Hertz might prove to be an important case study in the switch to EVs. The car rental firm revealed some results around EVs degrading in ICE residual values in the future during its Q2 earnings call this year. By comparing EVs and ICE vehicles, the business verified that its EV fleet, which consists primarily of Model 3s, continues to perform better than anticipated in terms of cost depreciation, maintenance, and customer happiness. Hertz claimed that while ICE cars and EV depreciation have much higher maintenance expenses, EVs only need between 50 and 60% of that amount. In addition, he mentioned that customers are more satisfied with electric cars than with ICE cars. Despite the fact that the market for electric cars is still relatively tiny, based on Tesla's fundamentals, the industry still has enormous growth potential. It could be wise to purchase and hold the company's stock. Tesla vehicles are leading and will stay leading, but there may be better sales possibilities in store. Tesla's valuation is still higher than it was a year ago, and the automaker's earnings are now predicted to increase by 79 to 4.05 cents. Earnings are also predicted to increase by another 30% to $5.29 per share in the fiscal year 2023. Top-line growth is also anticipated, with revenues predicted to increase by 39 next year and 54 this year to $115.38 billion. Pre-pandemic revenues, however, increased fourfold to $24.57 billion in 2019. While his rivals are losing money, Tesla is gaining it. The carmaker has grown to be among the most profitable in the world. Despite not outpacing Mercedes-Benz in net profit for the July-September period, Tesla beat both BMW and Volkswagen, with a net profit margin of 15% for the quarter. Without a doubt, Tesla's profitability is a major factor in its success, as the EV manufacturer has a number of advantages over other electric vehicle manufacturers in the market. The company intends to lower the price of these vehicles for electric vehicle enthusiasts worldwide, a move that Tesla has already started. Tesla still looks prepared for expansion, particularly because of its EVs. This is not the first time that Tesla has had to do this, so the automaker can potentially scale through even the worst recessions in the future. As it ramps up production at factories in Shanghai, Berlin, Austin, and Texas over the next year, the automaker believes that it still has more demand than it can supply. Do you think Tesla stock can rise to 10 per day in the future? Let us know in the comments below. Also, don't forget to tell us what you think Tesla is worth. If you want to learn more about what Tesla has been up to lately, click on the next video on your screen.